This is the December market report, and through the month of November and into December, sales have been pretty strong. Not quite as strong as this time last year. In fact, that's probably one of the challenges going into 2014 that consumers will have, is sorting out where the market really is, because the market is still very strong. It's just that we're coming off of 2 years in a row of record sales in terms of units. So when you're comparing to the prior year, in 2014, you'll probably see negative numbers, that we're maybe not selling as many units or just as many units as the prior year. And that might give sort of a negative feel. You'll see that listing inventory will probably start to rise a little bit in next year, and all those things have a negative feel to them. But really what it is just a healthy settling of the market. And 2014 we expect to be, it could be as good as 13, but certainly will be close to it. And there certainly is a lot of momentum in the marketplace for it. But there's also, going into the year, a very low inventory level. It's probably the lowest it's been in 10 years. And that does bode well for sellers. Values have risen about 8% if you compare December and November activity this year to last. And we think that next year it could still hold a 6 to 8% appreciation rate. But also keep in mind that there are less than 10,000 properties for sale right now in Southeast Michigan. There were 65,000 properties for sale back in 2008, the peak bottom of the market. So you can get a scale for how much that inventory has shifted. But we are seeing, in the last 4 months, we're seeing the number of listings coming into the market continuing to increase. Buyers have also increased, so that means the inventory has slid down a little bit. But those trends are looking very good. Also, one of the things that we're looking at as to where the market will be in a long-term basis is just how much buying power there still is in the market. One of the things that we look at is the Affordability Index, and that really is an index that shows what the median family income can buy in terms of the median price. And you'd like to see that index over 100. So 100 means that the median family income can buy the median family house, can afford it based on current interest rates. And in Detroit area, we like to see that index around 130, 140. But we're over 200 right now still, as high as it's ever been. So the question is, what happens when interest rates rise or values rise a lot? That takes a lot of buying power out of the market. So what's going to happen to buyers? Will they leave the market, and where does it land? And in our market report that we did for December, we showed that what would happen, some scenarios would happen if interest rates rose and values rose. And really it takes a pretty good increase in interest rates and a pretty good increase in values, about 20% in values and at least a full percentage point or more in interest rates, to drive that 200 number down to about 140, 130, which is the balanced market. Historically, that's been a healthy market at a 130 median index. So we look for that to happen, probably not in 2014, but maybe 2015, 16, as the economy improves and values rise and interest rates will probably rise because of that. So what does that mean? That means that we're probably in for probably the next 2 or 3 years of a pretty steady and stable real estate market. Housing values going up, not as wild as they've been the last 2 years, but still good news. So in general, for this year coming up, it's mainly smiles with a very slight chance of frowns.